Hi everyone. So in this video, I'm going to go over the pre-assignments from chapters 15 and 17 that I was not able to get to in the tutoring session. So there are three pre-assignments per chapter. So I'm going to start with chapter 15 and then get on to chapter 17 after that. So the first pre-assignment with chapter 15 is QS 15.8, and this relates to predetermined overhead rates. It says that at the beginning of a year, a company predicts total direct material costs of $900,000 and total overhead costs of $1.17 million. If the company uses direct material costs as its activity base to allocate overhead, what is the predetermined overhead rate it should use during the year? So for this, we're going to use a formula, and that formula is estimated overhead costs divided by estimated direct materials. That is going to give us our predetermined overhead rate. In this case, with the problem, it gives us those numbers. So we're going to divide the 1.17 million by 900,000, and that is going to give us a predetermined overhead rate of 130%. It's a pretty easy calculation. The biggest thing is just remembering the formula. The next pre-assignment, QS 1513, relates to job order costing of services. The problem states an advertising agency is estimating costs for advertising a music festival. The job will require 200 direct labor hours at a cost of $50 per hour. Overhead costs are applied at a rate of $65 per direct labor hour. What is the total estimated cost for this job? So again, we're going to be using another formula, and that is the total estimated cost is equal to the material cost plus direct labor cost plus allocated overhead costs. So let's break down the problem into these three parts and figure out those numbers. The first one is materials, and in this case it's going to be $0. There's nothing in the problem that explicitly states that there is any material cost, and I would say the reason for this, using the information above, is it's an advertising agency. In today's world, it is very likely that an advertising agency is going to be almost completely digital, requiring no physical materials. So that is probably the most likely reason why that there is no cost associated with materials for this problem. The next calculation is direct labor costs, and that is going to be calculated by multiplying 200 direct labor hours, which is the activity driver in this case, multiplied by the rate of $50 per direct labor hour. So that is going to give us $10,000 of direct labor costs. Very similar, to calculate the allocated overhead, we're going to multiply the activity driver of 200 hours by $65 per direct labor hour rate. And 200 times 65 is going to give us 13,000. So the final step here is to add the three parts up. $0 in material costs plus $10,000 in direct labor costs plus $13,000 in allocated overhead costs is going to give us a total estimated cost for the music festival advertising of $23,000. Similar to the last pre-assignment, the actual calculations are pretty easy. It's just figuring out this formula. So remember that the estimated cost is materials, direct labor, and overhead. Finally, the last problem here for Chapter 15 pre-assignments is exercise 15.4, and this relates to recording product costs. It gives us some information for Star Company from the month of August. It says we purchased raw materials on account in the amount of $76,200, used $48,000 of direct materials in production. The factory wages earned was $15,350, and our overhead rate is going to be 120% of our direct labor rate. Now it asks us to perform or to prepare the journal entries for raw materials purchased, direct materials used in production, direct labor used in production, and finally the applied overhead. So the first one, raw materials purchased, our journal entry is going to be this. We're going to debit raw material inventory and credit accounts payable. Typically in the past with other corporations, we would only use inventory as our asset account. When you're dealing with manufacturing companies, though, they break up their inventory into multiple accounts. The most common ones would be raw materials, work in process, and finished goods inventory. So, and that kind of just describes the state in which the inventory is in. So, raw materials means we have this inventory, but it has no purpose to us because it hasn't, or it has no purpose as it is because it has to be put into a product. So we are going to debit that for 76,200, which is the number they gave us, and credit the accounts payable, which is the liability, the amount we have to pay. The journal entry for direct materials used in production is going to be a debit to work in process inventory and a credit to raw material inventory. These are both asset accounts, but because we are using these raw materials in the production, we're kind of going to be transferring these assets from one account to another. So that's why we're debiting an asset and crediting an asset. So our costs are going to be accumulated in this account work in process inventory, and you'll see that more on the next slide here. So we are simply moving the inventory from raw materials to the work in process account by debiting one asset and crediting another. Okay, the next journal entry asks us to record the journal entry for direct labor used in production. This journal entry is going to be a debit to work in process inventory for $15,350 and a credit to factory wages payable for that same amount. Again, as I previously stated, the work in process inventory is going to be used to accumulate the cost of a certain job. So that is why we are going to debit this instead of debiting wages expense. We're not going to be using an expense account here. And then the corresponding credit, factory wages payable, is a simple liability that we're going to have to pay out these wages in the future. Finally, the last journal entry is going to be for applied overhead. So first we need to calculate, this is the past three journal entries, they already gave us the numbers. But for this one, we need to calculate what the applied overhead is going to be. So it told us that the applied overhead rate is 120% of direct labor cost. So what we're going to do is take that 120% and multiply it by our direct labor cost, which is what we just had up here, the 15,350. So 120% times 15,350 gives us $18,420. The journal entry for this is going to be a debit to work in process inventory for $18,420 and a credit to factory overhead for $18,420. Very similar to the last one, this cost is going to be, the expenses are going to be accumulated in this work in process inventory account, so that is why we are debiting it. Okay, now we're going to get into chapter 17. So the first problem in chapter 17 for pre-assignment is QS 17.2, which is cost allocation methods. So these are going to be multiple choice. I'll put them all up here and then I'll give you a couple seconds to try and figure out what it is, or you can pause the video and then I will go over the answer. So a lot of these again are just going to be memorization and just reading. So which costing method assumes all products use overhead costs in the same proportions? A, departmental overhead rate method, B, activity-based costing, C, all cost allocation methods, or D, plant-wide overhead rate method. And the correct answer to this one is C, all cost allocation methods. Second question says, which of the following would usually not be used in computing plant-wide overhead rates? Direct labor hours, direct labor dollars, direct labor hours, machine hours, or number of quality inspections. So as we went over in kind of some of the last problems, you might recognize the direct labor and the machine hours. We did not touch on quality inspection. So that is going to be the correct answer. We would not use that typically when computing the plant-wide overhead rates. And finally, 3, with ABC, overhead costs should be traced to which cost object first? A, departments, B, activities, C, product batches, or D, units of productions. The correct answer is B, activities. Okay, and then QS 17.7 is costing terminology. Again, these are just definitions that are in the book and just have to kind of read up on. So they had a couple terms and corresponding descriptions. So we're going to be matching them up. Activity. Activity is a task that causes a cost to be incurred. This is probably the most obvious one, as whenever you do something, that would be an activity. An activity driver. That is going to be measurement associated with an activity. So there can be multiple different kinds. I would say the highest or the most commonly used activity driver would be number of hours. It could also be number of employees or something along those lines. And some companies and industries would also refer to this as a cost driver instead of an activity driver, but they would mean the same thing. Next, cost object. Cost object is anything to which costs will be assigned. So some examples of different cost objects would be a product line, a certain department within a company, or maybe even a particular customer or order. And then finally, cost pool. Cost pool is a group of costs that have the same activity drivers. And then finally, the last pre-assignment for Chapter 17 is going to be QS 1712, which is cost of quality. So they give us a bunch of activities that generate quality costs, and we need to indicate whether it relates to prevention, appraisal, an internal failure, or an external failure. So the first one is inspecting raw materials. Would this be prevention, appraisal, internal failure, or external failure? This would be an appraisal. So appraisal or appraising and inspecting are pretty similar. There's no failure that is associated that happened that would make you inspect it. Inspection is just pretty routine. Training workers in quality techniques. This would be prevention. When you were training them training your workers in order to make sure that the quality is up there, you're preventing any internal failures that you might incur or you might experience in the future. Make sure that the quality is up when they first do it so that you don't have any issues going forward to prevent quality issues. And then collecting data on a manufacturing process. Very similar to the first one, this would be an appraisal, just because there's no failure associated with this, no prevention. It's simply just an activity that you would do, collecting data. Okay, overtime labor to rework products. What would this be? This would be an internal failure. If you have to rework products, that means that there was some issue with the quality when you first did it. And that issue with the quality comes from inside the company, so it would be an internal failure. Cost of additional materials to rework a product. Very similar to the last one, this would also be an internal failure. Having to rework again is a result of something that happened internally, and those costs associated with the additional materials of that product that had to be reworked, that would be due to the internal failure. Inspecting finished goods inventory. Very similar to the last slide, this inspection would be an appraisal. Scrapping defective goods. Again, this is another internal failure. If you have to throw away goods that you've created because they were defective, that's a cost that's going to be associated within your organization. And then finally, lost sales due to customer dissatisfaction. This is an external failure. How the customer feels about it and maybe losing future sales because of that is a failure, but it's not within your company. That's the feelings or the reactions from that customer, so it would be an external failure. So that is all of the material I have from the pre-assignments for chapters 15 and 17. If you have any questions on any of these or questions on other problems, feel free to send me an email.